Hello everyone. Today we are going to do a tutorial for our new spreadsheet, UOTS Spreadsheet version 2.0. We started with 1.0. We had several different iterations of version 1, but now we've built up enough changes to this so that we can call it 2.0, and I think it deserves a new video because the original video does not address all of the things that we've added since we've started. And the important thing to note that this spreadsheet is custom built for the UOTS trading strategy and comes together with a trading plan with all the details and everything. But you can also use it to track some of your additional trades, and I'll go over that as well. Just wanted to point that out right off the start. And you will see down there at the bottom, we have several different tabs, and the main naked puts, put debit spreads, and hedges are connected to the UOTS strategy. Then we have 11X because that's a popular trade a lot of people are doing. So I just created an extra tab so you can keep track of those trades separately. Some people like to do the Black Swan hedge, the 3-5 Black Swan hedge. I don't do it myself, but I've created a spreadsheet to make it easier for you if you wanna do that as well. And then we have performance and realized UOTS. Performance is tab that keeps performance if your whole account is doing the UOTS strategy. Then it's easy because you just keep track of the net lick on in whatever intervals you want. I do it once a week, but you could do it daily, you could do it weekly, and then you just record your net lick on the day, and the spreadsheet will do the little graph and all of the calculations for you. But some people only allocate a portion of their account to the UOTS strategy and still want to be able to keep track of the performance. So for them, I've created a realized UOTS, which tracks a little bit differently. Instead of tracking the net lick, we're tracking the actual performance of each individual trade and contract that we put on that's connected to the trade. And then the spreadsheet will take the data from the naked puts page, put debit spreads, hedges, and will calculate everything for you. So all you need to do is come in on the day and you put in a date, and it will calculate. Obviously, there is no SPY closing price yet, so that's not calculated. But it will then keep track, and you just put whatever starting amount. Let's say you have a $100,000 account, and you only want to do 30,000 or 40,000, whatever number is dedicated to this strategy. You would put it right here, and then any additions or additional allocations to the strategy, you can put it here on the left. The spreadsheet will calculate properly, add that so that it doesn't doesn't skew the results. It's properly calculated. And the same thing is on performance tab. You can add deposits or withdrawals here in the column A, and that will again calculate time-weighted deposits so that it's not skewing your results. So your actual indexed net lick, always starting from 0, is an accurate representation if you just had a lump sum at the beginning and going on, even though you're adding or subtracting money. But we'll come to that page again later on. I want to start with the first page on the left, and this is the usual update, just version improvements from the previous spreadsheet. We have a few things that we call out here, and you have some links that are now added for our studies. We do dynamic delta study, we did rebalancing tool, and then we have a UOTS trading plan. So everything is linked here for easy access. And important to note, whenever you update to the new version, all you need to do is copy paste the light colored cells. Everything else is formulas. So you just go to your old version, you make a copy of this for yourself, and then you copy paste these things here, and you copy paste these things here. Anything in light colored cells. Everything else is calculated automatically. And if when you do that, sometimes you might run into not an error, but sometimes the formulas don't run automatically, and you might have to click on, and I'll show you an example. I think I had one example here somewhere. Where is it? Sorry, I thought I have one. Yeah, right here. For example, it can show you the reference here, but all you have to do is come in and just click enter twice, and it will run the formula again and come up with the result. And that can happen anywhere on the spreadsheet when you're making a new one. And then once you set it up, it shouldn't happen anymore. Always when you have total profit and loss, you will have either red or green. Green for profitable trades and red for losses. But let's go back to here. So yeah, this is the updates and links, and then we go to the main page. This is like a cockpit, like everything is based from here. All of your decisions are made here, and then you record the trades in naked puts and put debit spreads later on. But here we need to break this down because it's important to understand. There seems to be a lot going on, but once you get used to it, it's pretty simple. It just takes a little bit to get used to. But in all of these cells, you will have a detailed explanation as to what the cell is about, and it should clear up if you have any questions. But you will start on the upper left side, and you will notice here that these are the parameters that you input in order to let me just remove this in order to set up the stage, so to speak. So the first decision that you want to do is, what's your target CAGR, compounded annual growth rate? And this is not a target rate for every year. This is the difference between this spreadsheet and one of the differences, and a lot of different tools that I see out there. People target specific return. They figure out, okay, I want to make 20%, but it doesn't work like that, because you have to actually account for the losses, the inevitable losses that will happen. Statistically, you will have some losses, and depending on the strategy that you have, the percentage winning, percentage losing, you have to figure all that out and then come up with an over time CAGR rate. So when you put here, and this is mine, I use 20. If you want to be more conservative, you can go 10, 12, 13, 15, whatever you like. But 20 is pretty aggressive. Anything over 20 is extra aggressive. So you have to keep that in mind. The higher the CAGR you target, the larger exposure you have, and the more volatility your account will experience. And you will have to take occasional losses that are larger than with a smaller CAGR target. But that's obvious, so we're not going to spend too much time on that. Estimated PCR, by default here it's 26. It depends on maybe a little bit on the instrument and the fees that you pay, and then also the deltas of the strategy. But using the MES for this UOTS strategy, MES as an underlying, 26 is probably an appropriate estimated premium capture rate. And this is important because this number here is used to calculate different things. The formulas take this number and use them for the for coming up with the different things that are needed. Stop loss or protective stop, we have it at 200% as a default. You can change it if you'd like, but 200 it's pretty good. It's an optimal one. 250 would work as well, but would require slightly larger losses when they do occur, when you have a book wipe or even a single loss stop loss. But 200 is here as a default. And then put debit spread cost allocation. And what it says, this is the amount of the premium, the percentage of the premium received on our naked puts that we are allocating to put debit spreads and put them on at the same time. And 20%, up to 20% is a default for the strategy. You shouldn't change that, because that would change other things as well. So it would no longer be the same strategy. So 20% is what's there. By default, yearly hedge allocation is 10%. You can change it down or up. I think 50% of your CAGR is a good starting point. And it might seem a bit high comparing to what's kind of advertised out there. A lot of people are talking about 3% of your net lick, and this is 10% of your net lick per year. What I find is that with 3%, you can hardly do any real hedging that will really protect you in a black swan event. So I go here with a higher allocation if you want to do the black swan protection, and it's not necessarily a black swan protection because we don't really want to stay in our trades for the full duration of the black swan. We want to use this, and we can call them semi hedges. We can use these to help us get out of the market's way as it goes down, and we want to try and get out with our stop losses. But this hedge allocation or hedges that we put on should help us contain that loss at a stop loss, because what will happen when the market is really going down, when either it's a black swan event or a strong correction, the liquidity is not as strong as it is in calm markets. The bid ask spreads widen up, and you might not be able to get out at 200%. You might not be monitoring your trades continuously, and you might miss the opportunity. So what will happen is generally you are likely to get out at a higher percentage, not 200, but maybe 250, maybe even 300. But you should get out at some point. Now, this hedge is meant to protect this difference. Anything over 200 hopefully will be protected or recouped by these semi hedges, and then anything above that would be a bonus, welcome bonus, but it's not guaranteed or expected. We do count on occasionally losing our 200% of the premium received, and it could be on a single trade or could be on a full book. But we monitor all of that, and everything here is here in the spreadsheet, so we have an idea of what that might look like if it happens. Okay, so that's on the hedging. We'll go a little bit more deeper in the hedging later on, but this is what it represents. Now, keep in mind, any number that you put in here is then financed by an increased number of trades or increased premium sold on the naked put side, so that our CAGR is still unaffected with this. Yes, obviously we are taking on a larger exposure. We are selling more premium to cover for this whatever percentage here we put here, but that way we keep our target here, and we use this money for the hedging as a separate and an addition to the original premium selling that we start with. Then here we have just commissions and fees, because different brokers have different fees. So you want to put a round trip commission. I put mine from Tasty Trade, and I do MES and ES mostly. So this is the cost of my round trip per contract. If you have a different broker, you can do something differently, and this is then pulled into different formulas to calculate profit and loss and things like that. Days trailing. Now, we want to be able to quickly take a glance at the previous whatever period, 30 days, 20 days, 7 days, or something, and we can quickly change the number here, and I'll show you here what happens when you do that. By default, it's 30 days. 30 days is a good number, probably a month. This is also an average time that it takes for naked put to be closed for a profit when everything goes fine. But you can then use this to quickly check yourself. Are you going in line with what you should be targeting in order to achieve? Everything is done in order to achieve your CAGR over time. But remember, this CAGR includes good times and bad times, and it should converge over time on 20%. And what that means is that in good years, like for example this year so far, and maybe it'll continue like this, the market is steadily going up or sideways, but it's not going down, and we are not having any stop losses. So in any year that we didn't have any stop losses, or we had only few, we will overperform this. And that's not really overperformance. That's the way it's meant to be, because you have to overperform in the times when there is not stop losses, because when they do happen, we will underperform. We will achieve less than this number. So maybe in 2 years we overperform, 1 year we underperform, but we want to look back and take a look at our CAGR, and we want to see that it's around whatever number we have here. That means we are on track with our plan. So if we put 30 days here, as in days trailing, you can see here that on the right hand side, the spreadsheet is keeping track of the trailing target premium and trailing premium collected, and then trailing put debit spread cost, in order to give us trailing percentage and trailing cost difference. But the important number here is this 19%. We don't really care about these number per se. We just want to see that the amount we're spending on put debit spreads over time does not exceed 20%, and we're okay here. It shows 90%, so 19%, so that's fine. But we also want to see that we are keeping track with the trailing target premium, because it says here that we should be selling, in order to achieve our goals, we should be selling around 5,700 for these 30 days, but we only sold 5,100, 5,200, call it. So we are a little bit selling a little bit less. So we just want to keep an eye on that. Doesn't mean we now want to go and make up for it, but we want to be aware of that, so that that we know what's going on. And this can be affected by the length of the days trailing. If you change this number, if you change CAGR at some point, but then you go back and include trailing days that were under different CAGR or under different hedge allocation, well, that's going to skew numbers a little bit. But if nothing changed over the last 30 days, then we should be roughly in line with the target. And staying on the right hand side, we can see down here that total premium currently open. This number is taken from the naked puts, and it only counts, I'll show you this one real quick, and it only counts the total credit that's still open. You can see right here, 4,600, that's still open. The ones that the trades that are closed are no longer important for this, only the trades that are open, because these trades present a risk at this time. And if this trade is to to be stopped out with a stop loss at 200%, well, we're gonna lose obviously 200% of this. Same here, same here. So we want to know how much that potentially can be. And the spreadsheet here will tell us quickly that if this is our open premium, then total full book wipe loss, which means all of the trades go to stop loss, and that doesn't happen too often, because sometimes you will have 1 or 2 trades affected, but not all of them. But we want to count the worst case scenario just to be on the safe side. So this also here includes all of the cost, assuming 20% cost of the put debit spreads. They're also included in this figure, and this is because we're paying for them, so they would be gone, and we want to then be able to count all of the all of the premium we receive from the put debit spreads that were profitable in the case of market going down and us experiencing losses here. We want to count all of that and then against these losses, and this is expressed right here. So let me just quickly show here. So we're looking at $10,000 at a full book wipe, and then we show what kind of percentage that is against our net lick. So right now we have 15% of our net lick at risk, assuming clean full book loss. By clean, I mean 200% and not much over. Now, this number is then reduced by certain amount from this value here, because this value here represents the total available open put debit spread if it was closed for 100%. Now, that's not going to happen often, so you only want to mentally use portion of that. It depends on exactly how old those put debit spreads are, how far away from the money, and things like that. But you know some of them will be profitable, so you can just if you want to just quickly have a look, take a look and say, okay, I know I'm gonna collect at least 3,000 from this against this loss. So I know, even though it says 15% here, realistically maybe I'm closer to 10%. In most cases. And then also in most cases, now these numbers are not real. I copied them from my spreadsheet, but only portion of them, so I'm missing some put debit spreads. Usually if I take a look at mine, these two numbers are gonna be kind of close. Full book wipe loss and total PDS value will be much closer than on the other spreadsheet, but it's not really important. It's just important that you understand what it represents. And then we have an important number here, notional exposure ratio. And this is basically a number that if you take the notional exposure of all of your naked puts and then divide it by our net lick, then this is the number here that gives us kind of a quick way to estimate our total leverage in the account. So this one is at 11.5, and that's on a high side. My actual here in my spreadsheet is actually at 6. This is just numbers in there. They're not really up to date, so don't look at that as an accurate representation of what's going on. But the way we figure this is if you go to naked puts and you take a look at all of the open ones. The spreadsheet here calculates the notional value of each of these trades, combines them here, pulls them to the main sheet, and then divides them by net lick. Net lick is pulled from here, from the last row here, because you manually enter this whenever you are getting ready to check your account or put a trade on or something, and then it will be automatically imported here. And you want to keep an eye on this, because this also represents a risk, and you want to keep it in check. And then we also use that to determine whether we can enter an early trade or no, or not. And that's right here. And again, it's calculated automatically based on the notional exposure number and on buying power usage, which is taken from here, manually entered by you in column I. And then in certain occasions when the market is going up quickly, then several of our trades could close ahead of time. We might be a little bit underexposed, and we might consider putting, it's not an obligation, but it's an option to put on another trade, assuming some numbers are in line, and that would be turning green, saying yes here if we are okay for an early trade. Okay, let's go a little bit further. Down here to the left, we have our deltas. This is a change from the previous spreadsheets, because we used to have, well, we didn't have any deltas here. We were just using one delta. It was basically 8, 9 delta. But we did a study, comprehensive study of and backtesting with different deltas under different environments, and this is a little bit as a result, we are now no longer putting just one particular delta, but we are varying delta depending on the VIX. So right now in this current environment, 12 delta is optimal for the strategy. If the VIX goes up, we might be able to lower the delta a little bit, and conversely, if it goes down, further down, we will increase the delta in order to keep our notional exposure, the number of units that we sell the naked puts, to keep them in check. We will increase, get a little bit closer to the money, and potentially further out in time in order to do that, collect more per each naked put. So let me see, I covered this. Okay, so we are here now, yearly target premium. Now, this is an important number, because the spreadsheet is using a formula. You can see right here, it's using a formula that takes into account the net lick and the CAGR and the PCR and all of these numbers here to come up with an optimal or not optimal, but required premium to be sold per year in order to achieve this under these circumstances, the statistical win rate, statistical loss rate, and all of that. And then this is further divided by weeks to give us a quick snapshot of a target weekly premium. Now, this doesn't mean you have to sell exactly this much per week, but what we want to do, we want to not sell any more than this per week, because that would slow down the schedule and we would be putting less than one trade per week, and that's not what we want. We want to try and do at least one trade per week. Actually, the more the better, but it's not necessary. Some people like to just trade once per week. If that's the case, you would like to kind of target around this number with your trading, and then the spreadsheet will calculate your next trading day right here. And if you target this, and if you sell this much premium roughly, then the spreadsheet will give you 7 days from now as your next trading day. So you can keep on schedule once per week. Now you can break this further down, which is what I'm doing. And I'm selling, let's say 700 or something. And then I get to trade twice per week roughly. And that depends a little bit on the size of the account and the underlying that you're using. But just to give you an idea what it is. And just the workday target premium, this is just something to give you like a little snapshot so you can see what's target per day, but you don't really use that unless you kind of want to do a daily trade, and then you can take a look at that and see if you can target something like that. But that's on that. Current week number, this just calculates what week of the year we are in. And early trade, yes or no, I explained earlier. All of these are formulas, so you don't touch any of these. You just change these as you need, and then you change these here. And basically, you normally, when you're getting ready to put on a trade, or once per week or once per day, you just come in, you fill up, you put in the date, you put the current VIX, your delta, portfolio theta, portfolio buying power used for the strategy. Like for example, I have some bill ETF, and I don't use that buying power used for the bill in here, because I can always just sell that. This is just short-term treasury bills that I have in order to get a little bit of extra profit on unused funds sitting in the account. And then I put my net lick here, and then the spreadsheet will do the rest. Now, before we move on to the naked puts, is there any questions? Are there any questions on the main page, please? No? All right, I like it. So no questions. We move on to naked puts. And again, keep in mind, these naked puts are specifically for the UOTS strategy, and UOTS stands for Unified Option Trading Strategy, or Unified Option Trading System, if you like. And those are the naked puts that we are selling as a part of the strategy. And you have predetermined, this strategy is meant for S&P products, so futures or index or even SPY. You could do it on some other underlyings, but this whole thing is built for the S&P 500. So this is how it works. We can in the future add some other things if need be, but basically you select here. If you larger accounts are usually gonna do ES, and even larger ones will probably have a portfolio margin, and they will do SPX, or maybe stick with the futures if they prefer. Doesn't really matter. Then you put a date when you open the trade. You put a strike of the naked puts, DTE. The spreadsheet will calculate the expiration date as well as the notional value. You put in the credit collected per contract and the quantity. This is MES, so I did 5 of them. And this is my total credit, some commissions and fees. And here, once the trade is closed, you come back and you put closing debit per contract, and you put a date closed. That will prompt the spreadsheet to calculate the profit and loss. Then here you can just take a look at how many days you spent in the trade, what was the per day profit, and then premium capture rate that you actually achieved. And it should be 60 here because this doesn't take into account any costs other than the closing at 60% profit, which you should put a GTC order. Once you place the trade, you go back and you put a GTC order at 60% and you let it ride. Okay, so that's pretty straightforward. Unless there is any questions, I will move on to put debit spreads. So generally speaking, we start with a naked put. Once we put that on and we know how much we collected per contract, then we know we want to spend up to 20% of that on our put debit spreads. And put debit spreads, with them, we want to do roughly, there are certain parameters that are clearly specified in the trading plan, but I don't want to go too deep into strategy because it'll take us away from the spreadsheet. But just to give you an idea, we were spending up to 20% in order to put on some put debit spreads that are around 30 or higher in delta with a long put, and then the width of those put debit spreads, where our goal is to roughly cover the premium received. So if you put a MES put debit spreads that's 100 wide, that covers about 500 worth of premium. So if you sold one for 500 and then you sold one that covers around 100, it doesn't have to be exact, just roughly to keep us on track, then you're doing good. That's what's meant to be done. And same as before, you basically fill up these lightly blue colored columns. The spreadsheet will calculate expiration date as well as the width, the value that is covered, and give you a total value. And this value is then transferred over, because as long as this number is here, as long as these trades are open, they can potentially be sold if the market goes down, and this is the maximum value they would collect. Then you put your quantity and the cost paid, and it will calculate everything else for you. If you close it, then you put if you sell it for profit, then you put the numbers here, closing credit and closed date closed. But if you don't, then it will automatically calculate loss once it expires. It will automatically, and I can show you that right here on my put debit spreads right here. You see, I didn't close any of these; they just expired, and all of these are losses here. And but that's part of the strategy, so that's perfectly fine. And let's see, and then this is self-explanatory. So, any questions on the put debit spreads? No. Okay, so now we'll go to hedges. Now, important to keep in mind, these are not the true black swan hedges, and there's a little bit of not misunderstanding, but some people call different things a black swan hedge. For me, a black swan hedge is one that would actually profit over and above from a black swan event, over and above your losses that you would experience otherwise. So it has to be pretty strong, but it's not going to trigger very often. It will really only trigger in a major event. Now, the little hedges that we're doing here, I would consider them more semi-hedges, because they will also only get triggered in an event that market is strongly going down, but they're not meant to cover the whole exposure that we have in the account. So it's not something that you can set and forget. True black swan hedge should allow you to profit without you even doing anything. It should really kick in and pay out if the market reaches certain low levels, goes down 20% or something. But this is not the case with these. These are meant to allow you to get out of the market in that case without experiencing huge losses. Basically, our goal is, in a black swan event, if we can get out losing our full book value as calculated by the spreadsheet, that's a success. And with that in mind, you need to understand then what target CAGR you targeting, because that will also determine the full book wipe loss and the possible drawdowns. So if you are uncomfortable, or if you definitely don't want to experience certain, let's say 20% drawdown, then you have to keep an eye here and make sure that this number minus whatever you think it's realistic for you to collect from here is not over 20%, because it is possible to experience that. So you want to keep that in line. So obviously the higher the target CAGR, the higher the full book buy loss will be. But what I wanted to point out is that these hedges, they're here to allow us to get out of the market in time and close our positions and not experience huge losses. And we have several different options here, but the main one is the rolling long put, and we have specific put that we do for that. We do a 14-day ES for those that trade futures, and then SPX for those in the portfolio margin. 14-day rolling ES put, low delta put. It's a high 1 delta, and it's at 14 days, and then we close it in 7 days, and we reopen, basically roll it back to 14 days, and we continue to do that. And that costs us a little bit of money every week, depending on how many we have open. And then that's if you have enough money in your hedging budget, then you can do that. If your allocation is smaller, account is smaller, or hedging allocation is smaller, you can consider short harvesting instead, and you can do you can pick any of the, not any, but some that are closer to expiration of your put debit spreads, but they still have 20 days or something like that to go, and then you can just go ahead and harvest the short side of the put debit spread, leaving the long contract open, acting as a small hedge in the account. That one is usually going to be cheaper than the straight purchase, but it's also gives you a little bit less protection. But it's all proportional to the money spent on the hedge. So you also have some hedges on demand, and they can also be recorded here to keep an eye on the cost and everything. So that's on hedging. On this one here, I no longer do 1-1-1s. I used to do them in 22 and before, but I don't do that anymore. They're similar in nature, and I had my spreadsheet, and then I just put it here and adapted it for those that do it. You can do it here, and each this double row is one trade where you have the naked puts on the bottom and put debit spreads on the top, and then it's all calculated and you can keep track this way for those trades, but they are not transferred into performance. They're not calculated in any of the other UOTS specific tabs. And same goes for the 3-5 black swan hedge. I know some people like it, so I created a spreadsheet here to help you with that, but I don't do it, so I'm not going to go deep into that, but it's here if you want it. Performance I mentioned earlier, but basically again, like before, you just change these numbers here in a lightly colored columns. Any withdrawals or deposits are put here on the left hand side, and the spreadsheet will automatically calculate proper time-weighted deposits and withdrawals that will not skew your returns and index net lick or the percentages. And then here we have year-to-date numbers. So here, for example, 2024, you go here, then you go into next year and start. And so you can keep year-to-date performance here. And then this column here, F, keeps your numbers since inception. So it jumps over, just goes through and continues on. And when it's indexed, what that means, it's basically whatever amount of money you start with, it's all converted to 100. So if you go further down here, that means you are up 4.83% from here. And same for SPY. And then that's shown here on a weekly basis, how you're doing, up or down per week. And then year to date, And then I've added here drawdowns because we want to keep an eye on that. Our goal is to keep our MAR ratio, which is the drawdowns divided by the CAGR, and if you or the other way around, okay, CAGR divided by drawdowns. But anyhow, you keep an eye here on this, and it will show you what your highest drawdown is from whatever point before. It always calculates from the highest point before to the current point. And then, so if it's steadily going up, obviously the drawdown will be zero because it was never lower than previous point. But then it will also keep an eye here on the max drawdown over time. So it will take into account the whole, as you build this spreadsheet and you go on, you will have more columns. Like, for example, I have here a little bit more, and I keep track on drawdowns since inception of the UOTS strategy. I started that in November, so I'm keeping eye separately because I want to isolate the UOTS strategy from my previous trades. And then it keeps eye here, and I can see here that my max drawdown so far was 0.5%, and the market was 1.5%. So those numbers are very small, and that's not consequential at all. So, and then the spreadsheet will here show you a chart or graph automatically built with these numbers here in column F and G. So you can keep an eye on how you're actually doing on this, and you can compare it to the market just to keep an eye. It's not that we are trying to continuously beat the market. We just want to get our percentage, whatever CAGR we're targeting. We want to achieve that over time, but it's good to keep an eye on how it looks on the graph. And then similarly, the one I explained earlier, realize UOTS. So if you only allocate certain amount to the strategy and not full netlick, you have to use this tab. It will do the same thing. These columns here are actually hidden, used just for calculations, but you don't really need to have them here cluttering the space. The same principles apply, but the numbers might be a little bit different because the trades will only be accounted for once they're closed. So whether profit or loss is achieved on them, and then they can be included in the numbers. As long as they're open, they're not included. So that might be a little bit different from netlick. I prefer netlick, but this is another option, and it will similarly keep a graph here for you. And the next one is sizing, and this, keep in mind, this is just a vague attempt of giving some guidance so that you just don't start completely blank, because this is not it's really not strict, and you don't have to follow this. This is just to give you an idea. If you're really just starting out and you don't know where to start, maybe this can kind of give you an idea. Okay, you have a $30,000 account. Maybe you can look into doing three MES naked puts at a time, and then maybe one MES to do a put debit spread. But then once you set it up in the platform, you can adjust it. So you basically you go to main, and let's say if you want to trade once per week, you would go to the platform, you would set up the trade, and you would see how much you collect. And if you're collecting more than this, then you change either to lower instrument, going from ES to MES, or from 5 you go to 3, from 3 to 2. It doesn't really matter. There is no strict rule, and if you like to trade more often, you might decide to do just 3 MESs, even though you might be account large enough to do 1 ES trade per week or something like that. But so this is just to kind of give you a guideline to have a starting point. And then here you have a little bit of coaching. This is not necessary because I do explain everything I do in the Discord and in the videos. But if somebody needs a little bit more hand holding or something, it's available here. You can do that as well. And this is also a good point for me to just point out that all of these tools are available to Discord members. And if you want to join us, the link is in the description below, and you will be part of the community, and we'll be answering different questions that you may have in the Discord. You will be doing live trading sessions that you can participate in. You will have all of these tools and continuously updated and latest version will be available to you. But that's, I think I covered mostly. So guys, if I missed something, please let me know, or if you have any questions, anyone. Nobody has a question? I will have to assume then that I did a pretty good explanation. So thank you for that. Look, if I remember anything, I will address it in the, one of the upcoming videos. Otherwise, that's it. Thank you very much and have a fantastic rest of the day.